So in today's video, I'm going to be showing you the strategy that I trade every single day in the stock market, how to set it up and what I look for, and then how I enter the trade. So to get straight into it, we're going to have to set up our standard deviation channels. Now, how do you do this? Well, there will be, check the first link in the description. I will share a link so you literally can just click it, import it, and it will set your chart up exactly like this. But if you do want to set it up manually, I will quickly show you. All you need to do is go over to edit studies or studies and then add studies. But all you would have is standard dev channel, and you want to add this multiple times. You'll have a 0.51, 1.52, 2.53, 3.5 to a 4. And then you want to change the colors. So this is our first deviation, second deviation, third deviation, fourth deviation. So you can go in and change the colors, but again, that will all be done for you if you just download the first link in the description. Now, once you have it all set up, do you want to add anything else to this chart? So on the on the left, which is the 4-hour chart, I tend to like to have some sort of volume chart. So I personally use a buy-sell volume. This is custom, but you can really use any volume. You can just use plain volume, because I just wanted to really just see how many shares are being bought today. Is it liquid? Is it not? Especially if I'm looking more at medium cap stocks or maybe even small cap stocks, I want to make sure there's enough liquidity if I want to get out of the position. And then on the right, which is the daily chart, this is usually where I like to have some sort of momentum indicator. I tend to just use RSI, that's my preference, but really you can use any here, MACD, whatever it is that you like to use. Basically just I use this to detect is there any divergence. Now, so the charts are completely set up. You have a 4-hour, 180-day chart and a 1-year daily chart. These two are mainly just used because they give added strength. Yes, you can use this strategy on, say, a 20-day, 1-hour, and a 30-day or something. But really, the 4-hour and the 1-day daily charts are really the strongest. Obviously, you can go even further out, like 3-year and a max chart. But with those, really there isn't going to be too many trades because the deviations are so wide. So this is really the sweet in between, at least in my opinion. Now we have the chart set up. Now what are we looking for? So really this is quite simple. All we're really looking for is stocks. If we want to buy them, we really just want stocks to come down to these deviations. So for example, this first, second, third, or even a fourth deviation, and these would be our buy signals. And if we want to maybe short the stock, then we're looking at the first, second, third, and fourth deviations. So that is, in a really simple way, kind of just what we do. If they're coming down to these zones, we look to buy. If they're coming into these zones on the upper end, then we look to sell. But obviously there is a bit more detail, and so we'll go into that now. And we'll go through a live example to kind of show you what we're looking for. And it's one I personally did trade. If you are in the Discord, again, in the description if you're not already. This was posted in here and was one I personally executed. So we will need to go back in time so you can see where the deviations were in current time. So now you can see we have used the on-demand feature, which allows us to go back in time and see basically as if we were trading it live, so we can start seeing where the deviations were. And you need to go back in time if you want to backtest this strategy, because the deviations move every time the chart updates. For example, on the 4-hour 180-day chart, this chart updates every 4 hours, and on the daily chart it updates once a day. So these levels will change every single time the chart updates, little by little. But really, if you're looking at a month time difference, then that is going to be a big difference. So really, if you're looking to backtest this strategy, you need to go back in time. And so now we're back to where we actually entered PG previously. You can see that it's come down to its third deviation on the 4-hour and also on the daily. So this, again, like I said, this is a buy indication to us. Once it's down to around 132.50 on the daily, and it's at 133.25 on the 4-hour, these are our buy zones. And we can see on PG that it has come down to these zones, and this would indicate a buy to us. And so really all we would look to do is buy the stock here. Again, we may execute this in different ways because we are looking maybe to trade this in different ways depending on how the market is currently acting, how this stock is acting. But we'll get all into that at the end of this video. But there is timestamps in the description if you want to see how we're going to execute this, because there's 3 different ways we look to execute. But so if we were looking to get long, this is really all we're looking for. As simple as that. Once it comes into these deviations, that is coming into a buy zone. Now, if you want to increase the accuracy of this strategy, what you can really do is look for added confirmation. And how do you do that? Well, you can go onto like an intraday, probably recommend something like an hour chart. And all you want to see is basically a bounce off this level and buying pressure coming in. So what we have seen is obviously we sold down to this level yesterday and we're starting to close above it. So once we start closing above this VWAP, you could use it as confirmation. But I imagine you have some sort of market knowledge by now, or depending on what your current strategy is, you have some sort of way to gauge confirmation, and really that's how you improve the strategy. I'm not giving you this strategy just to completely copy. You should try and make it your own. So if you're looking to use this strategy, use your own sort of confirmation. What do you justify as confirmation? And whatever you use to justify confirmation, once it's bounced off this level, you find your gauge of confirmation, then you could be looking to get long on this stock. Now, as I personally really only use this strategy now on large cap stocks, yes, you can use it on any. I used to use it to trade small cap stocks, but now I mainly just trade large cap stocks. And because all the large cap stocks in my watch list are all stocks I believe in fundamentally and are fundamentally strong, I don't really have to look for too much confirmation on how I trade. It tends to be when they come down to these levels, I'm quite happy just to buy. And the reason for that is I've already done my fundamental analysis on it. I know they're good stocks to be buying, so really buying at this level, I'm happy to do it. So really all the analysis or the fundamental analysis is done prior, then all I'm waiting for is a technical signal, and my technical signal is coming into a deviation. Really, I tend to skip this first deviation, and the reason for that is if you understand how standard deviation works, 68% of the data will be within the first deviations. So that is, quite a lot, but it also means that around 30% of the data will push past it. So instead, I prefer to trade off the second and third deviations, because 95% of the data trades within the second deviation. So really, more likely than not, a bounce is going to happen. And you saw that on PG when it came into this second deviation, you got a strong bounce. But now it's continuing down and coming down to its third deviation, which 99.7% of the data should stay within. So I know buying here, more likely than not, it's going to bounce. So that is really my buy signal. Now, how do I find a sell signal using standard deviation? Well, really, it is the same kind of thing. And we'll go over a current example actually right now, so you can see, depending on when you're watching this video, how this trade would have worked out. So I don't want to just go back and show you an example that we know works. Even though I did trade it, I'm going to give you an example now that hasn't yet played out, so you can see this. If you come back, check in a week or a month or whenever you're already watching this video, and you can see how did Rite Aid play out, because we're going to give you the levels now on where we expect the stock to start pulling back and where we are going to short. So we can see on Rite Aid actually where it is right now at around 10.75 is our second deviation on the daily. So this is a level where we would expect the stock to start selling off. So we could be starting to short the stock here. But really we can go even further levels. So $12.25, $13.25, $16. And we will ignore this fourth deviation for the time being. But really these four levels are the key ones that we want to be paying attention to, because these are levels where we expect to Rite Aid to start reversing. Obviously we could reverse now, and if so, then we already have that indication or this level indicated. However, we have our next strong level at $12.25, our next one after that at $13.25, and a kind of final one at $16. So now how would we trade this if we're trying to be short bias? So there's a few ways you can trade this. Firstly, you can just trade the initial hit into this level. And again, if it's a third deviation, I would just tend to do this. However, like Rite Aid right now, we're currently sitting at the second deviations. When we're sitting at the second deviations, I look for a bit of confirmation, and the reason for that is it could go higher, and really I want to get the best price possible when looking to trade. So obviously I can maximize profit and have a smaller loss when they do encounter the loss. So right now we're at second deviation. So if I'm looking for confirmation, really I'm looking for us to come into this level, come and retest this level again and see selling pressure kick in. In this case, we kind of come into this level, we're kind of hesitating here, but we haven't yet shown enough selling pressure for me to be able to short the stock. So on Rite Aid, I'm either waiting for it to kind of break back below this 1075 level with a bit of selling pressure, or I'm waiting for it to push up to this 1227, and then again I will be looking for the same thing. Is selling pressure coming in? Once it does, I could be looking to short. However, if on Rite Aid, no selling pressure comes in to the 1075, no selling pressure or not enough selling pressure coming in at 1225, we could kind of, I don't want to say blindly short, but we could just short once it comes into this 1325, because really we would expect a strong pullback coming into this 1325. Again, that's all we really need to look for. If it's a second deviation, again, we try to look for some sort of confirmation just to improve the probability of the trade working. However, if we're coming into this third deviation, then we're quite happy, or at least I personally am, quite happy just to short coming into this level, because I know more likely than not a pullback is going to happen. I will kind of go over how you execute these trades. So there's three ways, like I said. Either that's buying / shorting the shares. It's going to be using just a plain option, meaning we go long or call or we go long or put, or a debit spread, which can also be known as a bull spread or bear spread, depending on which direction we're going to do it. So again, like I said, timestamps are below. If you only want to trade shares, then the first one's for you. If you don't mind trading options, or you want to learn a bit more about options, then again, check those timestamps, or just watch all three, because again, I personally use all three of these ways to trade, and depending on how the stock is, market conditions, the different way can be better. So Rite Aid we will use for the example throughout all three of these examples, just because it will make it easier and clearer to understand. So firstly, like I said, we can trade it just using shares. So what we would do is, really coming into this 1225, we could literally just short shares of Rite Aid. Really simple as that. How do you justify, or where do you pick your stop loss? Obviously, I want you to kind of pick that for yourself, because depending on how comfortable you are, you may have wider stops, you may not. But if you just want like an easy rule of thumb, and if I'm going off the second deviations, I tend to just go to the next psychological level. So in this case, 1225, you know, a stop just a bit above $13. However, in this case, you can see that is where the third deviation is, where our stop would be. So in cases like this, and you will have this quite a lot of the time, especially on these kind of lower value stocks, if they're less than $100, this will probably happen quite frequently. And the way I would do this is either don't trade the second deviation and instead wait for the third deviation, or take reduced size at the second deviation so you can average in and increase your size of the short coming into that next key deviation, because again, third deviation is our key one. We don't really expect it to go further or past this stop, this level. So really, if our stop was at $13 and we don't expect it to go really past another 20 cents, it gets a bit, well, it seems a bit pointless to get stopped out on something we don't expect to go much further. So in these kind of cases, you can average in, but again, it's just plain shorting. In this case, just shorting shares. And if you want to reduce some risk, or you maybe don't want stop levels, meaning you don't want a stop loss at say $14, you can counter this by having a hedge. And how do you do that? You just buy an option, the opposite. So obviously, if we're shorting shares of Rite Aid, the way to hedge it is just buying a call at say the strike price of $14. So that's really how you can trade it, just using shares. Again, you may want to incorporate some options as a hedge, depending on how you personally want to calculate your stop losses. But now getting into method 2 of trading this strategy, and that is using just a plain call or a plain put. And by that I just mean being long a call or long a put, depending on how we're trading. And on this Rite Aid example, obviously we are looking to short. And so in this example, all we would want to do is short. And how would we do that? We go over to trade, we go over to all products, at least if you're on Think or Swim, because this is where you're going to get the option chains. And then all you would do, depending again on your expiry, I tend to personally go quite far out, because in like kind of the 60 to 90 day range or less, you get quite a lot of time decay. And so if I'm just buying a option, I'd rather not be too affected by the time decay, so I tend to go quite far out, 160 days, as in this example, buying January calls or puts, and that works, at least for me, quite well. I'm happy to do it like that. So how would I trade Rite Aid? So we're currently sitting at $11, and I expect it to go below. What price do I expect it to go below? $10.50. So really, all I would be looking to do is getting a strike of then $10, and we can see we're on the put side. All we would look to do then is literally buy a put, and it's really as simple as that. That's all we're really looking to do. And then we also have to define risk. So let's say you're happy to risk up to $250 on this trade. All you then need to really do, or then you can only really buy one contract, at least at the $10 strike, because that is going to cost you $200. So that is your max risk on the trade. But again, you can always go further out, or you can mix and match. For example, get a $10 strike and say the $6 strike, because that would cost you $250. So if your max risk was $250, you could increase kind of your potential or your exposure to Rite Aid by getting two different kind of strikes. So that is kind of how you would expose it. You just pay $200, and that would give you your short put or your long put. And so yeah, prices start to decrease, and obviously your value should go up. Now, what is the difference then between getting, say, a $10 strike and a $6 strike? Well, being at the $10 strike, you're closer to the money, and what this basically means is you're more likely to kind of close it in a profit, which also means this stock will, or this option will react stronger. And if you understand delta and all of that, you will have a higher delta. In this case, the put on Rite Aid at the $10 strike has a 32 delta, whereas if we go and check that $6 strike, it only has a 9 delta. And what this basically means is, let's say Rite Aid goes down $1, your option is going to increase as if it went up 32 cents. Sorry. So in this case, that would probably push the option to around $250 from the $200 it is currently at now. Now at the $6 strike, again, that only has a delta of 9. So it really just means if Rite Aid falls in the dollar, or falls at $1, like it would to our $10 strike, we're just not going to make as much money. In that sense, maybe the contract goes up to, say, 60 cents instead of 50, which would mean obviously $10 increase. This one would have a $50 increase, but obviously you're risking more to get one closer to the money. So again, on your own risk parameter, you may feel more comfortable getting closer to the money, or you may feel more comfortable going out the money. But again, that is up to you. These are just how you can trade. Again, make your own adjustments to the strategy. Now, on to the final way that I personally trade the strategy, and that is through using debit spreads. Now, what is a debit spread? So all that is just buying and selling a similar or a one strike difference option. So, for example, we would need to buy, say, the $10 strike, and then we would look to sell the $9 strike, and you can see this would create a debit of 48 cents, which in this case would mean we have to pay $48 for this option, which does mean that our max loss would be $52. So in this case, you can see it's near enough a 1-to-1 risk to reward. Now, why would we want to trade like this? Well, what a debit spread basically does, or in this case a bear put spread, is basically all it means is at expiry, as long as the stock is below $9, you make your max profit. So in this case, we would make $52. But what it also means is if it expires above $10, then you take your max loss, which in this case would be $48. So that's really how it works. If it's below your strike, when you're shorting, obviously you want it to be below your strike, then you make your max profit, and if it's above your strike, then you take your max loss. Obviously you can widen how far you play these out. For example, you could be buying the $10 strike, but you could look to sell, say, the $8 strike, and what that will do is change your max risk from $90 per contract and you would have a max profit of 110. So again, depending on how far you think the stock's going to move on your risk parameters and all of that, you can then pick how you're going to, or how far away you're going to have your strikes and all of that. But it's just a general concept of debit spreads and how they work, and that's just you buy the more expensive one, you sell the cheaper one, and as long as it expires below your strike price, you make your max profit. And again, if it expires above your strike price, then you take your max loss. So that should be quite simple. Now, how can you trade this? Do you want to hold this to expiry? Do you have to do nothing once you enter? Now, again, this is two ways you can trade it. Let's say you open this up today. We see it expires the 20th of January. So as long as Rite Aid is below $9 come the 20th of January, we would make our max profit. We wouldn't have to do anything. We could just buy it today and leave it until expiry, and that's perfectly fine. You can trade it like that. And depending on the market, I will usually trade it like this. Like usually when we're going back a year, quite an easy uptrend. It was quite an easy market to trade. Really, you could trade like that, especially if you're taking them as cool versions, meaning bullish versions. You could really just leave them, and they would usually just leave them to expire. You get your max profit. However, in this kind of market, we keep selling it off. We keep getting these pullbacks. As of right now, obviously, we're on the line of kind of leaving this bear market. So where this market is very volatile, I don't want to be in these trades to expiry, because I don't know if Rite Aid is going to be below $9 in 160 days. In this market, it's too volatile to kind of even get a close prediction. So instead, you can close them out when they're in profit. And how do you really do that? So let's say on Rite Aid, in the next few weeks, we drop to $9 or $8. And then what you can really do is just close that contract out. And all you really need to do that, I mean, it will be quite easy. You can just click closing order, but all you would have to do is basically do the reverse. So you would sell your $10 strike, you would buy a $9 strike, and that would close your position, and you would be able to lock in profits. Obviously, that won't give you your max profit, so in this case, it wouldn't give you $52, but you could get close. You maybe make $40 per contract, or around that value usually. But again, if you can, say, lock that profit in 2 weeks or a month, it usually makes a lot more sense to kind of do it. Yes, you lose a bit of the max profit, but you're guaranteeing that it's a profit, and then you also don't have to wait another 130 days to get to your profit. So again, you can close them early if it makes sense. But really, those are the overall ways that we would look to trade the market. The strategy, which is using our standard deviations, and how we would execute them, whether that's just shares with a potential hedge, just buy or getting long a call or put, or using debit spreads. Hope you enjoyed the video. If you did and you want to watch another video from me, you may enjoy this one or this one.